Good evening to all. Thanks, Raj, for the introduction. Good evening to all the participants. And first of all, thanks from JM Financial for giving out your valuable time to hear us out on our monthly webinar series. So, till now, all the webinars which we have conducted has been really very helpful. That's the feedback we have been getting from our clients, and really it has helped people to find out more clearly how the indices, how the stocks, how the sectors will fare for the month, and hoping I will do justice in this short webinar on how the indices or markets are expected to move for the month of October. So for the month of October, if you look at the important things which we should note, or which I would rather cover in my short webinar, is how we look at the index for the month of October. That is the path of Nifty for the month of October. So when we're talking about Nifty as an index. Secondly, we'll also be addressing important aspects as to how the futures and options positions have been rolled over from the September month to the October series. And thirdly, we will be taking you through some important events which you need to keep a tab on. And definitely, without the webinar being concluded, without an option strategy or an option trade would never happen. So that would be the bonus you can carry from this webinar, where we will be giving out to you an option strategy which will help you to move this month with clarity, and also an option trade which I think would bode well for our option traders. So starting off with the webinar, well, we have been through volatile times in the month of September. September series was more where prices showed a directional move which lasted for long. This is normally not a characteristic of a normal market situation. There was a time where from beginning of September to the mid-month, we saw a rally of over 1,000 points. Similarly, this entire rally cooled off, the momentum faded off, and we were in a phase which not many had seen before, because 9 days of back-to-back selling which happened in the second week of from the third week of September was something which really caught the market participants on the back foot. 9 days of one-to-one selling back-to-back did see significant gains being shaved off from portfolios. Really, which way the markets are going, what is the next direction, was the question mark. And luckily, the way the October series has started off in the last 4 days just is a reminder that the volatile times are there to continue. Now, if you look at the chart which I have placed on on the screen, I have drawn a blue line. This is called a trend line support. Now, time and again, if you look at this trend line support, the markets have respected this blue line and have recovered with a strong force whenever the blue line has been met with the prices. And the last move again just validates the fact that whenever the supports are tested, the move which ensures is a very strong one-way move. So 25,180 roughly is where we close today. And my sense is that the way the prices have been moving in the last 1.5 2 months, these recoveries, when they come back, are going to be hard. So we're looking at a positive markets. That's the first thing I would like to bring to the audience today. Then the Nifty technical setup is extremely positive. There have been some choppiness, there have been volatile days, but eventually, if you look at the broader setup of the market, what we get with concrete evidence on the technical charts is a support of 24,000 in place, and this support gains in confidence as the momentum picks up. And possibly what you can look forward is the resistance of 25,500. That's the first target you can look forward to, and 25,650. That's the broader target for the month of October. Now, VIX, which when you talk about VIX, it is the volatility index. VIX normally means that how the fear is embedded in the system. Are people fearful, or the markets are more stable? VIX at 10% just means that there is stability in the market. So although there have been times where the markets have fallen one way, really the VIX, all we could manage was a jump in VIX from 7.5 to 11%. So really, VIX is not the worrisome factor right now. Some price choppiness is, but eventually I think the markets is in an accumulation zone. It is cushioning the negatives and setting itself up for a possible breakout about 25,500 in the days to come. Rollovers surprisingly were on the short side when we started from September to October. In the last, the fag end of September, we did see rollovers of around 83%, which are more than the historical average numbers. But the last 5 days have seen some short covering in the market, and that bodes well for the future. That's the next couple of months. So support 24,800. That's the roadmap for October. 25,500, 25,60. That's the upside target we forecast based on the data points at this given point for the month of October. September month, big moves have come, which it is known for. Now it is the time for October, where seasonally October is known to be a cold month in terms of the price moves, where 5 out of 3 times seasonal patterns for October have seen negative returns. But I think the way the markets are shaping up, this is the month which is going to defy the historical seasonal pattern for the indices. And my expectation is that we are heading for a positive close in the month of October. Bank Nifty, there's where the initial signals are coming from, because whenever you look at these two indices, you need to see how the Bank Nifty is placed and how the Nifty is placed. The leader is the Bank Nifty. When you see strength in the Bank Nifty index, you can be more sure that there is an underlying strength in the index. So we are talking about a head and shoulder break in Bank Nifty, which is an inverse head and shoulder pattern, which we saw 4 trading sessions back. And that pattern itself is suggestive that Bank Nifty is slowly paving way for its all-time highs of around 57,500 levels. So Bank Nifty is taking the lead. You had September where PSU banks were supporting the move in the bank index. Private banks too have joined the party. Nifty is slowly shaping up well. So yes, with Bank Nifty taking the lead, a strong technical pattern in place, I think the broader market is definitely heading for a strong breakout going ahead. When we talk about Nifty and we talk about options, we have to see where the options put and call writers are placed. So that gives you an additional confidence about the kind of support we are talking based on the technical evidence. So we speak about 24,600 as the support, as I spoke in the last few minutes. Option placement is at 25,000 in put. And mind you, this is not just the weekly options I'm talking of. These are weeklies. These are monthly. I'm talking about 28th October. If you were to pull up the data and check where the highest put writing is in terms of the open interest built up, it is at the strike of 25,000. So almost at the money strike, huge open interest build up right at 28th of October expiry just gives me more confidence to say that the traders, the way the derivative traders are positioned in the market, they foresee less bottom or a low cap, you can say, for the month of October, less downside, and possibly call writing at 26,000, which is far away from the breakout zones of 25,600. Just signals that the call writers are taking it more safe. They are shying away from writing closer strike. They are opting for writing 26,000, which is pretty far off from where we are right now. And that just validates the positive view which I talk about the Nifty index. Moving to the second slide, where specifically we are looking at now, we have a framework where we are talking about a positive view for the indices. Now, which sectors you should be concentrating on? So I've just highlighted a few sectors completely based on the rollover analytics in the futures and options space. Positive roles have been noted in the auto space. Now, you can remember that autos have been the biggest beneficiaries of the GST, and the auto numbers are clocking, the sales numbers of them have been rolling, and that is boding well from a momentum perspective in most of these names. So in autos, if you were to kind of pull out stocks which have strong momentum yet, although you might say that they have already a fair share of the move and it's time that there might be a price discounting move for the month of October. I feel still the momentum is there in the auto space. That's the sector where the strength is. And in auto specifically, stocks like an Eicher Motor and Ashok Leyland, and the third stock here in this pack will be a Hero Motocorp. These are some of the stronger names in the auto pack. Maruti, which is the fourth name, which can do well in the month of October. So keep these 4 stocks on your radar. These are stocks where the long bets have been rolled from September to October. The momentum is strong still. It's just that there has been some bit of a lackluster move in the last few days, and I believe there is one more round of momentum yet to go in them. Metals have been shining well. Most of the metal stocks have done wonders till now. We have seen stupendous gains in majority of these metals. So really you will question me as to should I be buying metals at this point? And the answer continues to be yes. But I will be more stock specific here because I will not run after metal stocks which have already enjoyed their fair share of move. So specifically stocks in metal sector which have yet to stage their breakout and which are kind of setting up on the derivative parameters for that much awaited breakout. One is Steel Authority of India, where the level of 140 is a very important pivotal level for this stock. A breakout of 140 just sets the stock up for significant upsides of 150 plus. Have this on your radar on the buy side, and keep a stop loss below the levels of around 130 in this trade. The second stock here, if you were to look from the metals pack here specifically, would be a Vedanta, where there is a corporate action building up, and we believe there might be some positive momentum on back of this action. So in all the trades which I'm mentioning you, these are not recommendations. These are a view which is shared on the basis of the data which we come across based on the rollover analytics. These are calls which have been shared in our live markets. And any trades you take, if you are trading for the month of October, you need to maintain a stop loss of roughly around 3% from the initiation price at where you take. But broadly, the way the data is playing out, it is positive. Banking, no doubt, is doing well. As a sector, the banking stocks, PSU stole the limelight before. Now it's the time for private banks. So Axis Bank, IndusInd Bank, ICICI Bank, and HDFC Bank. These are the 4 stocks in the banking pack which are on our watch list. Again, Federal Bank is one which has been recommended from our fundamental desk and technical desk as well. This is more of a momentum trade, and I think this too should do well for the month of October. Now really we talk about the top 3 sectors, and if the markets are a bit shaky, where are the short bets concentrated? Has to be IT. But surprisingly, this is the result season. The IT trend has been down. A lot of short bets are still present in the IT names, and there has been a slight bit of a short covering rally which has lately helped the IT pack to recover. So really do not go hard on shorting IT names as of yet, because it's the result season, and this is the time where a stock specific approach is more important than an index specific approach, because each stock will have its own flavor depending on the results which they come out with. When we take a broader month for October, we have to see as to what the FIIs are doing. And really, when you look at these data which are pulled up from the NSE websites, month-on-month data, still the FII's outlook on the Indian market is not improving. It is still cold. The approach is that they have been sellers. You may blame it on the depreciating rupee or the flows chasing the emerging markets, but these numbers have a lot to say. So if you look at the trend from the month of July, the left hand side is the data which is prevalent in the cash markets. They have been sellers in the cash markets. DIIs, the domestic institutions, have largely been supporting the market. And in the index future segment, the situation is still bleak, because the long short ratio, where we track the open interest positioning of FIIs, is 7% longs to 93% short. So it's almost near the rock bottom levels, where the quantum of short bets are so heavy in the system that really that does make us believe that there might be a round of short covering. But we would say that do not jump the gun and just trade on a single piece of data. Wait for other indications as well, because for short covering to emerge, there must be some strong piece of evidence. Then only the shorts will be covered. So ideally, if this long short ratio improves from 7% to over 12-13%, that will be the initial feelers that yes, the FIIs are covering the shorts in the Indian markets, in the index futures, and their opinions are changing. So let's understand that there is a cautious approach from FIIs. This is what we need to understand going by this piece of data. So as I mentioned, we spoke about the FI positioning, important supports and resistance to watch has been discussed. Keenly, what we will be looking ahead for this month will be the global news, because a lot is happening globally, and really that does impact the Indian markets. Tariff update will be the key for the indices in the next couple of months. There are some reports doing rounds about talks being on about some relief in the tariff numbers. Really, how they will shape up is a big question mark, but really time will tell. But at least what we understand is that the worst is in. We know now for sure that these are the tariffs which India needs to pay. These are the restrictions which are on the Indian exports. So things cannot go bad from here. That's the initial sense which the sentiment is deriving. And from here, if there is any kind of relief, if it were to happen in the days to come, that hope will play out in the sentiments, and any positive news on this front should be the momentum for the market in the coming days. So keep a close watch on the tariff updates. The FII flows, right now the FII flows are not picking up, but if there is an improvement in the long short ratio, which I discussed a couple of minutes back, that would be a strong evidence that things are turning for Indian markets and the data might improve. Customer spending on the festival season, as we move to the big mega festivals in India, there is going to be a lot of spending this month. Probably GST measures are going to further fuel the spending. So numbers in terms of the sales are going to really augur well for most of the FMCG and consumer names. And I think that should boost the sentiments going ahead. Lastly, as I mentioned, we do always give you strategies, right? Our webinar never goes without recommending you as to how would you use options as a product to strategize yourself. And really the best strategy which I mentioned here is more of a spread strategy here. So the underlying view for the index is positive, which I discussed in my webinar. We are trading at 10% in VIX. So really the strategy is here that we are buying a 25-200 monthly. That's a 28th October put, which is at the money where we closed. It's trading around 206 as we close today. And we are selling 2 lots of 25,100 put, which roughly per lot would give you 128. By setting up this strategy, which is more ratio put strategy, your upside, there is no risk, because we are selling 2 puts and we are buying 1 put. So the risk actually is on the lower end. The risk starts if Nifty would go below 24,900 and roughly 24,900 zone. So I would say that keep a stop loss basis spot Nifty for the worst case scenario. Your stop loss is if Nifty goes below 24,900. That's the point where we need to review as to what is changing the face of the market for October. Right now, our view is positive, and for that we are playing out a ratio put spread where buying put 1 lot 25,200, selling 2 lot 25,100 should give you a return of around 2% if we expire roughly in the range of 25,050 to 25,150 zone. Even if it goes up, you still make good returns. I think around 6,000-7,000 odd per lot in this strategy is what you can look forward to, even if the Nifty runs away about 25,500. So this is a good strategy if you are strategizing using options. For option buyers, if you are a call buyer in options, I think it's straightforward. 25,500 is the best trade you can look forward to. That's the way we target, and there are various products to target. You can go for covered calls, you can go for vanilla options, but each financial product has its own flavors. So follow the recommendations which we actively come out on during live market. Our hero zero calls, our basket approach, our vanilla calls which we have been given. We have been striving for that strike rate of 75%, which we are achieving, and helping our clients to generate the desired returns which they look for. So we will keep you posted on all the different strategies and calls as and when the opportunity presents. But I think I will conclude the webinar here. So it's a short webinar, The direction for the October month is charted. This is the probabilities. 25,500 is where we look forward to. 24,900 is the support for the Nifty, and wishing you all the best for the month of October. Thank you.
We shall now begin with the Q&A session. How to select the right strike price?
Interesting question, because whenever we take seminars, we always get this question as to, we make a view on the stock. Now the problem is, when we trade in options with a positive view, we get the view right, but we don't make money in options. So the choice of strike is the factor, because options, when you choose options as a product, you have to know the nitty-gritties of it, because Greeks come into play when you choose strikes. So a simple thumb rule, since we have limitations on this webinar, I would say that when you choose a strike for an option, you need to decide which time of the month you are in. So for example, say you are in the beginning of the month when a new series kicks off. For the first 10 days, if you have a positive view on a particular stock or an index, and you really your analysis points out that you're looking for an upside of minimum 4 to 5% from the current market rate, you can look for deep OTM calls which are 3 to 5% away from the spot levels. So the approach of buying deep OTM calls, which is one of the most favorite approach for most of the retail clients, would work if you are at the beginning of the series. Second, you have a positional view, and your analytics point out that 3 to 5% minimum up move is what you look forward for. If these three criteria are met, go for deep out of the money strikes. Now the second question is, what if you are just a week away from the expiry? Here is where the trap lies, because after you've done your analytics, and you have to be very specific about the momentum part, because time value is a killer. As each day passes and the stock does not move as your expectation, or even if it stays flat, you are losing a small percentage of the option premium, which is called time value, and that is really what eats into your option premium profits. So here, timing is the key. If you are good at timing using technical indicators, then only give this a try. I would suggest that if you have a target in mind, do not go for deep OTM calls. Go for at the money or in the money calls if you are in the last week around the expiry time for stocks or for indices. So this is what my recommendation is. It is not that this is a foolproof method, but it has worked for me. It works. Hence, I would suggest to use this approach when you select strikes whenever you trade options.
How to check FII position in derivatives script wise, particularly from where can I get this data?
So now, look, a lot of free websites are available which give you this information on the FII positioning. See, I would say that at JM Financial, we are doing a lot of research for you. We are making a life easier for you. So if you are signed up as our client, all you have to do is look at our morning reports from the derivatives desk. Now we are taking the trouble of collating this data, picturizing it in form of easy readable graphs and charts, and simplifying the data analytics for you, so that you have all the pieces of data ready at your coffee table before the market opens. So if you look at the reports which are released pre-market, this would hit your mails or your WhatsApp by 8:30, 8:45. So here all the analytics in terms of what is the long short ratio, where is the open interest position in terms of the bars or the skyscrapers, as you may call, what are the important stocks you need to keep a track on based on open interest. All these data are available to you, so you need not go and get into downloading stuff from the website. But still, if you are more keen on doing the analytics yourself, in the NSE you have to go to the derivatives section, and there you have to download the F&O Bhav copy data, where they give you a segment-wise breakup as to what the FIIs are doing and in which product they are long, in terms of Nifty, if you're talking about how many positions are long and how many positions are short. But when we are talking about FIIs, it's a group. It's not a single trade. So it's what the entire community of FIIs is doing at a given point of time is what the rough idea you get looking at this piece of data. So these are the two ways where you can have access to the FII data.
What do we need to take care of on an expiry day for index futures?
See, on the expiry day for index futures, first of all, I'll tell you, expiry day is not an easy play. Let me tell you this, because there are the best minds, the best algos, and it really defies all logics of analytics the way expiry momentum or volatility is. So really you have to be on your toes if you are trading expiry day in options on the index. So what would be the possible point where you can capture the move on the expiry day? If that is the question, first of all, you should have the skill set of pinpointing market reversal points based on technical analytics. If that is the skill set you have, then life becomes a bit more simplified. If not, at least from the derivatives piece of information, you can figure out the support and the resistance for the expiry day based on where the highest open interest is positioned on that particular day. So depending on the quantum of the number, for example, let's say puts have 100 open interest, just an example, and calls have an open interest of 150. Let's say 25,000 put has 100 and 25,200 has a call writing of 150. It clearly means that this is the support, this is the resistance, this is the highest number which I'm looking across the option chain, and this gives me the support and resistance. So whenever this data is breached, let's say the markets are positive, it breaches 25,200, and suddenly you see that the open interest at 150 has come down from 150 to 75. It's a very clear indication that call writers are starting to exit. And if you see this phenomena immediately, it means that call writing unwinding will fuel the Nifty further, and that is the point where you look for hero zero expiry trades. So these are small momentum points which we search for. Obviously, it needs a lot of experience, and if you were to follow our calls, I think they can do wonders. For example, we had a hero zero in Sensex which we recommended today. We did this actually in the morning session itself, where a 100 rupee premium turned out to be a doubler in the next 1 hour itself.
Which type of options should I trade in?
Yeah, so first of all, as a beginner, and you want to foray into futures and options, right? So I would suggest strictly you have to go for option buying. No ways writing, because option buying is about limited risk and limited risk and unlimited gains. So the maximum risk as an option buyer, whether you're buying puts or you're buying calls, is the premiums for which you commit yourself for, and the gains can be unlimited. It depends on the move in the stock. Now the second thing is, which options should I choose? Now NSE has given you options in indices. When I say indices, it is a Nifty or a Bank Nifty, which are two popular products. And when I talk about stocks, these are stocks where all the F&O products are listed. So on today, I think there are around 180 or 200 stocks which are roughly trading in the futures and options segment. So as a beginner, my suggestion is always go for liquid options. When I say liquid options, those are options where manipulation is not easy, options where there is a very strong trading interest, and for that the spot or the stock should move for the option price to also move. So manipulation does not becomes a challenge for such activity. So for a beginner, always go for index based options. It can be Nifty or it can be Bank Nifty. Go for slightly longer duration of a time. Do not go for jump for the weekly options, because weeklies will eat your time value premiums at a pretty fast rate. Secondly, if you're opting for stock options, choose only Nifty 50 options, because there is where the high liquidity lies. So as a beginner, that is where you can start with.
If I want momentum, which parameters should I watch for in option buying?
Well, at least if you're on the momentum front, first is in technicals, you follow candlesticks. So whenever there is a big, huge green color candle, it just shows that the momentum is picking up in the stock. So ideally, my setup is, if I were to watch an intraday, I would normally have a 30-minute setup on my screen. So any abnormal green candles which are more bigger than the average that itself signals that the momentum is catching up. Now, to confirm this momentum, technically you can use a 9, 21 or 50-day moving average on the intraday charts. Obviously, if your prices are above the moving average, it is an indication that momentum is catching up. So these are some technical indicators, basic technical indicators to be with the momentum. You need to understand where the resistance is and where the support is before you attempt catching momentum, because you need not be caught in false breakout scenarios. Secondly, always supplement your studies and technicals with derivative reading. Now, in derivatives, you need to understand where the highest open interest is in terms of put writing and highest open interest is in terms of call writing. So these are bars which you see in the option chain. The highest number of open interest across the option chain inputs is where the support lies, and vice versa for calls. So if a resistance or a support is breaching and you note any kind of a change or an unwinding where the open interest which was there before has started reducing, that means that a support or resistance is broken, and that is most likely a momentum trigger for the market based on the derivative reading. So if you combine technicals with the derivatives and basics which I just mentioned, that works most of the time.
To identify which strike price will blast on expiry day.
So again, expiry play is a very difficult play. I mean, catching hero trades or multi-bagger trades, you never know when they will hit the screen. And honestly, out of 10 trades, there are just 2-3 times when you see these multi-bagger trades at work. So as a simple rule, again, I would reiterate that you need to follow the open interest bars, the put and the calls, where the highest open interest reading is on the option chain. Once you see the support or resistance of the open interest bar being breached, immediately you need to track how the open interest is playing out. I'm repeating this again and again because that's where the momentum catches. So any momentum is fueled when the open interest starts shedding or unwinding, and that is the trigger. So for expiry day, you need to see where the highest open interest is. For example, suppose 25 to 150 is where Nifty spot is. 25 to 100 in calls is the resistance, because a significant chunk of call writing is seen at 25 to 100 in terms of open interest buildup. Now say during the day 25 to 100 is broken by market, 25 to 20 is where it goes to. You will see that open interest at 25 to 100 starts reducing. It means you will see a negative figure in open interest gradually if there is shedding, and that is itself an indication that the open interest is shifting to higher strikes. You will see the highest open interest now shifting from 25 to 100 to maybe 300 or 400. So it just gives you the possible target zones where the market might head for. Put writing will shift from 25,000 to 25 to 100 because the breakout has taken place. So these are finer points. We do have webinars for you time and again where you can benefit from such studies in understanding. So please join our interesting webinars which we conduct month on month basis to give you a fair understanding of how the option markets work. These are some basics which you need to stick to if you are trading weekly expiries.
Thank you, Akshay.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.